Shall I start with, sir?
Yeah, please start with.
Yeah. Good afternoon, CA Gyanchand Mishra, sir, who is the chairman of Insolvency and Valuation Standards Board. CA Durgesh Kumar Kabra, sir, who is the vice chairman and will be joining soon. CA Parag Kulkarni, sir, who is the faculty for today and the resource person. He is a good registered valuer and he has done so many works on valuation. Good afternoon, participants. I welcome to you all to this series of webinars on valuation. We have 3 webinars in line today on 13th and on 20th of June. All the renowned speakers who have lots of practical exposure and experience in valuation will be there. They will share their perspective along with an insolvency professional. With this, I would welcome Gyanchand Mishra, sir, who is the chairman of IVSB. Welcome to you, sir.
Thank you, madam. So, should I start, madam?
Yes, sir.
Thank you. So, very distinguished speaker of today's program, Parag Kulkarni ji, and all the respected delegates, and Madam Sarika, who is instrumental to organize such wonderful program in the interest of the professionals at large. Good afternoon to one and all. Friends, I am really happy to note that today the board is organizing such a wonderful program, and valuation, which is very important and very integral part for the professionals as on date for the purpose of the practice. And most importantly, we see valuation with respect to the insolvency proceedings. That becomes certainly backbone for the purpose of the professionals who are doing the practice for the insolvency. And of course, the value with respect to the assets of the corporate insolvency, that is very much relevant in this regard, because until unless the value is proper, probably its impact with respect to the maximization of the value for the corporate debtors, that is not met out. So friends, today's webinar, which is with respect to the various do's and don'ts for the valuation professionals is concerned, I think that no other person than Parag ji could be the better professional who could guide on the subject. As far as do's is concerned, I think being a professional, we have to maintain certain level of the ethical standards at first. Documentation, of course, the another area which needs to be focused. Continuous upgradation of our knowledge, and to understand the valuation rules and methodology with respect to the need of the client and the market conditions. That is also very much relevant. And don'ts, if we see, I think that the first most important, that the valuer has to be impartial. He has to go with the various standards, norms, and he has to keep himself, impartial. And the most important thing, that the professional skepticism, which is very much need of the hour for the valuation professional, that should also be maintained. Friends, I think that the time is here when we are learning a lot. And in this series, on 12th and 13th of July, again, the board is coming with this International Convention on Insolvency and Valuation. And the theme of the convention is maximizing value. So that is very much needed, that we maximize the value, not only in terms of the valuation of the various assets of the organization, but to maximize our value also. How we can enrich our value, that is very much needed. And that only comes with the various seminars, webinars, and knowledge enriching session. And in this series, we are coming with last year, the professional might be knowing that we had this program in Singapore, and more than 350 professionals across the world attended the program. This year also we are very, curious to welcome the various professionals, not only from our own country but from other countries also. We are getting very good response, and Bharat Mandapam, one of the best destination and location of the country, that has been booked for this event. So we'll request you all, we'll request Sarika madam to kindly share the detail in 1 minute to all the participants, and we'll request all the participants to please join the event in Delhi and make it a grand success. And I'll once again request to Parag ji to kindly, guide to the members, and you please motivate the members whosoever are in your touch to join this program. So over to Sarika madam to brief the event, madam, in 1 minute only, so that members could be aware about the event.
Yes, sir. So, as Gyan sir has already told, this is the second edition of our International Convention on Insolvency, Resolution and Valuation. This is on 12th and 13th July physically at Delhi at Bharat Mandapam. Fees for the event is 7,500 for the members plus GST, which is also very minimal looking at the venue which we have, Bharat Mandapam. There are other opportunities also. After the session of Parag sir, we'll have a 5-minute slide run on all the aspects of this convention. It will be very beneficial as speakers from India and international will also be joining. Judiciary will also be joining along with Chairperson NCLT, who has kindly confirmed. Many judges of Supreme Court have also, former judges of Supreme Court have also confirmed to join for this event. So altogether, it will be a very learning event where we will have chartered accountants, insolvency professionals, registered valuers, registered valuer entities, insolvency professional entities, basically committee of creditors also, which are banks or bankers, along with policy makers. We have been also joined, this event is jointly with Insolvency and Bankruptcy Board of India, which is a regulator for insolvency and valuation. Also, we have been joined by ICI Registered Valuers Organization, as well as our triple IPA, Indian Institute of Insolvency Professionals of ICI. We'll have a 5-minute session or presentation on this after the session. So please join, mark your calendars and join with us. We will also send mails to all the participants who will join us in this webinar so that they are aware, and we'll send the brochure. Yeah, thank you, sir.
So much thank you, Sarika madam, for giving the brief about the event. And without taking much time, I'm thankful to one and all for patient listening. And being valuer, we have to start the value ourselves first. So please be precise that the knowledge sessions, what we are learning, that we have to do toto. And this event, what we are marking in our calendar, that will certainly be beneficial to all the professionals at large. So thank you, Sarika, for this great event, and I'm thankful to Parag ji for giving his precious time. Thank you.
Yeah, thank you so much, sir. I would take 1 minute to introduce Parag sir, although he does not need any introduction in the market for valuation, and also Ind AS, which I have never introduced him as an Ind AS from Ind AS perspective, but he knows Ind AS in and out. He's first and only Indian chartered accountant from 4 countries. He has done CA from India, CPA from USA, CA from England and Wales also. He has also received high honors from New York Stern Business School for advanced valuations from August Hands of Valuation Guru Professor Ashwath Damodaran sir. He has received honorary degree BFP from Chartered Accountant Institute of England and Wales. With this, I would welcome to you, sir. Now you can take over and start the session.
Good afternoon, esteemed colleagues, valued professionals, and most importantly, Gyan Chand Misra sir, chairman of and VSB. The vice chairman who is not present here, but I must also name him, Durgesh Kumar Kabra sir. and more importantly, Sarika madam and her entire backend team. I congratulate all of you for coming up and encouraging members for these three different series as well as the Bharat Mandapam event. And to be honest, it is, as always, truly an honor and privilege, to be with you here. I want to extend warm welcome to each and every one of you who has taken time to be here in this afternoon. And I'm very much sure that all of you are very busy professionals, but thanks a lot for valuing this time and coming up and joining this particular session. Genuinely speaking, your presence truly reflects the shared commitment of excellence in our field, and I'm excited, to engage with such distinguished audience. To introduce the topic, I would say today we are gathered to discuss a topic that lies at the heart of our profession. And I want to genuinely compliment the team for selecting this topic for me. I have been speaking more on a core technical topic such as the DCA valuation or maybe the multiple based valuation, and not really have spoken more on the peripheral topics, which certainly becomes important as we go ahead. So as a registered valuers, we play a crucial role in the financial and economic landscape. And our valuation influences major decisions from investments to legal proceedings, impacting both individuals and corporate stakeholders. And hence, understanding and implementing best practices is not just beneficial, but I think it's very much essential. Best practices serve as guiding framework. And this guiding framework ensures that our work is accurate, it's ethical, and more importantly, it's reliable. Like in the profession where profession and integrity are paramount, and adhering to such practices helps us maintain the highest standards of the profession. It safeguards the trust placed in us by our clients, by regulators, and obviously by the market at large. And hence I believe that the best practice discussion is important. And moreover, these best practices obviously mitigate the risks, enhances the quality of conclusion, quality of the valuation, and more importantly upholds the professional reputation. So considering this, even a single mistake in our valuation process can lead to significant financial losses or legal repercussions either onto you as a valuer or to client, and last but not the least, a tarnished reputation of a profession. Often when I address a lot of conferences, mainly in the startup events, people come and they quote some significantly higher valuation on the one hand side, and on the other hand side, investors come back to me and say that we invested so much with this particular uh, uh, quality of the security, this type of security, by agreeing to a particular valuation because some other VC has agreed on to particular valuation. And you have seen what happened to some of the giants who sponsored Indian cricket, who did a lot of advertisement by doing a lot of burn in Indian market. And it's very unfortunate, but ultimately it trickles down to the reputation of a valuer who performs those valuation or the one who performs the deal. Thus, our discussion today is not merely academic, but I believe it carries profound practical implications. So I'll give you the overall thought process which I have in my mind for next, let's say, 1 hour or 1.5 hours, which I want to discuss with you. I think I want to structure this discussion with a comprehensive understanding of uh, obviously the best practices, which means first we need to understand our role as a registered value. Secondly, we must look into do's, that okay, what are the essentials and we must do that, which are must to be done activities, and then which are don'ts for the registered valuers. And I will also I would love to discuss on some of the case studies, maybe 2 3 or let's say 4 case studies, where I'll try to speak on do's and don'ts. So in the first discussion, I think we'll begin by defining our role, exploring the responsibility scope, and even discussing the regulatory framework within which we operate. But aim of today's discussion is not to bring out the section numbers of the regulation, but at a very peripheral level, understand that you and I understand either we do valuation under Companies Act or for SEBI, or even sometimes we offer our valuation as a chartered accountant under Indian Income Tax Act, or sometimes you don't do valuations under the regulatory processes, but we do it for the deal making. and deal may happen, your valuations may become a part of it, but whether those deals are sustainable or not, that much relies on the way you conclude the value and conclude those deals. In the do's, I think I'll try to highlight the essential practices that we must adhere to. Like I said, it's a bare minimum compliance framework that I feel. I also believe that we must also engage in a conversation around continuous development, continuous professional development, continuous education development. We must also speak something around due diligence and a very clear and comprehensive reporting. One of the do's which I believe, which I'll be thrusting upon in my that particular delivery, is eliminating the ambiguity out of report. I have seen multiple reports where the value conclusion is there, but value conclusion relies on the information that has been presented very ambiguously. And I think that is not very effective way of communication. I understand there could be certain pressing points at your end when you perform your valuation and reporting it. But how can you bring it through caveats or disclaimers? And if not through disclaimers, how you can you really address those challenges through sensitivity is important. Ultimately, the communication that you have through reporting must be effective. And despite the issues in which you work, as a one of the two, how should you maintain the confidentiality of the client data, including now in the internet of things and in the AI driven technologies, where often people might be copy pasting a lot of client content with the open AI or Gemini or similar other AI models. And is it really do category or don't category content? I think let's try to discuss on that as well. In the third layer of my discussion, like I said, I'll focus more on the don'ts, where I'll feel that we should look at obviously the common pitfalls and the practices to avoid. But we must also then very specifically look into the areas such as conflict of interest, or maybe certain cases, the over reliance on the assumptions, and also in certain other areas of neglecting the regulatory changes, or in order to ensure the quick outcome and the client delivery, I have seen skipping some of the verification processes or verification steps. Uh, and once my articulation around these three areas is done, I'll prefer to discuss with you some of the the practical examples, both for successful valuations and also for those that where in our internal organization we feel those were the failed valuations. And I don't want to discuss only the case studies with you. I'll also prefer to discuss with you the lessons that we learned or the insights that we have out of those discussions. And after this particular discussion is over, maybe we will have some time for Q&A, where we can have interactive session where I'll try to address questions and facilitate discussions on the topics that we have covered today. So in summary, today we aim to equip you with the knowledge and tools to excel in your role as a registered valuer. Obviously, that doesn't guarantee your success, but it's somewhere, I believe could be a good guiding principle. By embracing and implementing the best practices, ultimately, we can ensure that the valuations are accurate, or at least we can believe them to be accurate. They are more reliable and they are more trustworthy. So thank you once again, like I said, all of you being here, and I look forward for this engaging and insightful discussion. So with this, I think now I'll begin with my first thought process about understanding our role as a valuer. Uh, with my opening remark, I will say to begin, let's first define what is meant to be a registered valuer. And I don't mean by a theoretical definition or a legal definition. Obviously, registered valuer is a valuer, who is qualified with those IBBI examinations to perform valuation of assets, whether it's a financial asset or intangible class asset that you and I do as a chartered accountant, or whether it could be, the property such as plant and machinery or land and building. Apparently, we are discussing about valuing a property, personal property or a public property, valuing businesses, valuing securities, valuing tangibles and intangibles. So anyone, who is licensed to perform these activities is obviously now classified under IBB as a registered valuer. And what is our primary responsibility as a registered valuer? Apart from looking at the section numbers and saying that, okay, I'm doing valuation under particular rule or regulation, the very key fundamental responsibility which is onto our shoulder, is to come out with a value that fulfills the definition of fair value. And I think, like me and Sarika madam few days back were discussing, the definition of fair value has been defined very differently under different frameworks. Like accounting standard still continues to define fair value as arm's length price with the old definition. And after the debacle of financial crisis in USA in 2007, ISB and FASB came together and they changed the definition of fair value, and they have now included the exit price scenario in that. And now we have new definition of fair value under IFRS or index. And if you look at the third framework, IBBI's framework, IBBI defined fair value even differently than the way it is defined in AS or index. So our primary responsibility is to work obviously in the regulatory environment, but more importantly to conclude a value which can be construed to be a fair value, right? And for which we need a very fair assessment. A value concluded under fair assessment by utilizing a fair processes with the fair mindset is a fair value. To me, that's the epitome of the fairness. It can't be broken into the words and phrases. I think if you know you are independent in mind, and if you know you are fair at heart, and if you know that even you are fair in your understanding and learning, then I think the value conclusion definitely would be fair. And obviously then then this particular fair value then can be utilized for a specific purpose such as financial reporting or mergers and acquisitions, taxations, litigations, and investment analysis. So as a valuer, our role obviously is multifaceted. And I think our role goes beyond an activity of estimation. I understand that we look at the financial statements, we try to draw a trend and then perform a regression to look at the future and the forward looking simultaneous equations that we have. And we use a lot of mathematical and statistical tools. But while we do so, while we engage in those statistical and mathematical activities, we should also conduct thorough research and analysis, which obviously includes capturing the relevant data, whether the comparable peers are relevant or they are irrelevant, or whether there are certain outliers which are included in that particular data point in order to achieve the hidden agenda or motive. You need to assess the market condition. Like, look at just pre-election result stock market, how it was. A day before the election result, how stock market performed. As on the election date, how stock market performed. And now after one day of the election date, how stock market is performing. Now, when you look at so much of volatility, the real question is whether the value that you concluded 4 days back was relevant or not. And hence, stock market do not represent a fair value, it represents a price. And hence, we say there are certain stocks which are overpriced and there are certain other stocks which are underpriced, right? So, performing a research, having a fundamental analysis, having right tools where you can rely on authenticate data is very important. It's one of the must. Secondly, once you have performed the analysis and when it comes to writing of the report, I have seen few reports which are, like 5-page reports, 10-page report, 12-page report. And I wonder really with the minimum content requirement guidance, which is given by Companies Act, IBBI, and ICI as well, ICI review as well. How can anybody write and conclude a report which is of 12 pages, of which first 4 pages are introduction, last 4 pages are disclaimer, and then whatever has been done is done in those in between 4 pages. I think we need to stop assuming that nobody's watching us. We need to stop presuming that performing valuation is only mathematical Excel based exercise. You must prepare detailed valuation report, which are clear in communication, which are comprehensive in conclusion, which are well structured, and which will provide all necessary information to the stakeholders. Please ensure that your reports are comprehensive. And please don't come back saying that the fees that has been agreed by the client allows us to work in a given limited environment. I understand, like you have the fee pressure, possibly many others do have. But trading off the quality of report is not a solution. IBB has taken very serious actions against those who have not done the reports correctly, diligently. You have passed these exams after a lot of taking, pains, and this is again after a lot of pain, right? So now respect that. Uh, don't don't be under a facade of assumption that nobody's questioning me today, which means nobody will ever question me tomorrow. I think the talk bearers are watching us, the regulators are haunting us. It's your and my responsibility that we empower each other and tell each other that, irrespective of the fee part of it, we must ensure the comprehensive report writing. Now, while we do so, the next third point in my list, in my diary, is maintaining the transparency and objectivity. And our assessment must be impartial. I remember one of the CFO coming to our office and discussing that this is particular engagement. And just before leaving, my cabin, he said, "Okay, fine, the engagement is done. I believe that my valuation is X." And it so happened that my team members were also with me in that discussion. While they went back and performed the valuation, their value conclusion was different than the X, which was anticipated by the CFO of the entity which engaged us to perform this valuation. And because he had a perceived value in his mind, because my team member had a perceived value in his mind, which is X, he believed that our value process was wrong, or and hence he went back and rechecked valuation almost 3 or 4 times, and then finally came back and said, "Sir, my value conclusion is fundamentally different." And what CFO quoted, "What should we do now?" So I asked him, "What should we do now? You tell me, what should we do?" And he said, "Sir, how about let's change the discount rate?" And I said, "Now you are basically swimming in a very dangerous trajectory. You believe that you want to achieve that valuation, and if somebody wants a particular valuation, which is basically then the top down approach, where you first understand what value you need, and then that's how you reframe the Excel model." And then very innocently my employee said, "Sir, should we change the prospective financial information? Can we increase the revenue by, let's say, 10% more, or can we increase the margin by, let's say, 5% more?" And that's a very dangerous trajectory. So objectivity exercise as a professional comes here with. And I think it's one of the key character that we all must possess, because like CA as two letters reflects a trust, CA along with the registered value reflects a greater trust on the value conclusion. So please, my heartfelt request to all of you that don't indulge into activity where you are ultimately sucking to the expectation of the client, but remain objective. And instead of you changing those numbers, let your client come back, change those numbers with rationalization. If those numbers can be truly rationalized, if it can be set according to the trends, if it has rightly captured the company specific risk premium, then I think then it's still okay to look at potential adjustments, which are, borderline adjustments. But if anything that makes you complacent around hota hai ye kar do, then that's a very dangerous trajectory. Hence the fourth point becomes important. Fourth point in my judgment is communication with the client. Very effective communication with the client. It's paramount for us and it's essential for us to explain our findings and methodologies in a way that is understandable even to the non-experts, helping clients make informed decisions. If client is coming and asking you, "How have you calculated beta and what is the meaning of beta?" You and I must have patience to explain what is the meaning of beta. And you must explain how you and I cannot change the beta value because it is driven by the market forces. It is not an assumption. Beta is not an assumption. Risk-free rate is not an assumption. Similarly, there are all other external inputs which are not assumptions, but are purely driven by the market data as of a date of valuation. I think I'll speak less on the regulatory framework and compliances, like I said, but I'll still try to give some insights around it. Obviously, on the regulatory side, we have IBBI, we have companies registered valuers rules. Um, then we have uh, licensing and certification requirements. We must also adhere to valuation standards issued by ICAI. If you are doing international engagements, you must also adhere to valuation standards issued by IVSC, which are international valuation standards. Can you please switch on the air conditioning? Yeah, thank you. So, and apart from that, another regulatory framework in which we might work is framework loaded onto some other stakeholders such as auditors. And auditors, as a part of their exercise, looking at the impairment testing, and hence they ask you to perform valuation. Or maybe as a part of financial reporting, certain derivatives must be marked to market, or certain equity instruments, like previously in banking segment used to call available for sale FS. Now we have FVTOCI category or FVTPL categories. Now for all these categories, the origination of valuation requirement is not very specific to the section of Companies Act, but it is originating through Indian accounting standard. And I also know for a fact, some people arguing back that Ind AS is not Companies Act. The registered valuers must perform valuation only under Companies Act, and hence valuation can be performed internally by the management or can be done by, let's say, some other chartered accountants who are not registered valuers. I have a very straight opinion. I think, like I always say, let's not try to unnecessarily break our heads or opinionate on something which uh, very much biased, or the opinions are biased. In my opinion, Indian accounting standards are notified under Companies Act. Hence, they are integral part of Companies Act. Though Companies Act particular section do not very explicitly mentions that the valuations under Ind AS must be carried by registered valuers. My urge to all Indian chartered accountants is that you please have on board as a valuer only those who are registered valuers, because these are the people who are licensed to perform these valuations. These are the people who perform, or who upon whom you can be trusted. Just because you are a chartered accountant but not registered valuer, and you are hiring such kind of person, may not always bring uh, the absolute correct outcome, for obvious reasons that he has not yet undergone the kinds of pains that the registered valuer has to go through and other do when it comes to standard. Secondly, if tomorrow that value conclusion is wrong, then as only, let's say, chartered accountant, or let's say as a non-registered valuer, uh, ultimately the entire burden will come onto your shoulder, and not onto him, because you relied on his opinion when his opinion could have been the less reliable in that sense. So I think, try to find a best way possible out of this regulatory environment as well. I know for a fact that uh, accounting standard also ask for valuation, such as, unfortunately, we do not have the accounting standard on his, we have only guidance note. And everyone in the market says that guidance note is not a part of accounting standard, which are notified under Companies Act. And hence, we need a valuation of ESOP. But without having valuation of ESOP, how will you then account for those employee costs, right? So there are multiple areas. I think we need to go beyond the book sometimes as a registered valuers to communicate effectively with the clients. And your client may not always be a direct company, but could also be a chartered accountant for whom you are working, or with whom you are working. So try to convince these people that there is importance of the framework. And though on the regulatory side, it may be a gray area where the valuation must be done by registered valuer or not. Registered valuers are best individuals to perform such valuations. Now let me move on to my next thought process. And by the way, I've written all thought process which I had in the morning in my diary. So I'm reading one by one and trying to bring my articulation around it. For me, the next good point, important point is ethics and integrity, which our chairmen are also described. I strongly believe that the cornerstone of our profession is ethics and integrity. And these principles are absolutely vital for maintaining the trust and confidence of our clients, regulators, and even the broader market. So, when we say ethics, what does it really mean? I think we need to look at five key aspects. The first is, like I said, trust and credibility. Second is impartiality or objectivity. And I think, I've already explained you what does it mean, that we need to be unbiased, regardless of the client pressure or external pressure, or we must be so objective that we must be away from the personal interest, right? So I mean, the objectivity is very much essential. It brings the accuracy and reliability onto the conclusion. The third point which I believe is the professional reputation. It is not only about me as a registered valuer, as my reputation. When entity goes into insolvency proceedings, the very first person who authorities want to hang are valuers who have performed valuation for bankers. It could be a case of mortgage where you and I as a financial valuers have not played a critical role, but imagine still they are valuer brothers. And when the news come in the economic times that the valuer is debarred, it's not only demeaning the profession of land and building valuer or plant and machinery valuer, as in toto, it is demeaning all of us as valuers. So I think that professional reputation is important. The fourth point, which I believe is another important aspect in ethics and the integrity part of it, which is the legal and professional obligation. See, non-compliance. So ethics, according to me, is not just a conduct. It is not just a professional expectation, but I believe it is also legal requirement. You and I, with the ethical standards of ICI and ICI review and even the IBBI and even under the Companies Act, we all are expected to behave ethically. Not to breach those ethical standard is very important. And when I say so, it may not always meant to behave properly in a valuation segment. Even the way you treat your employees, when you go to the customer place, how you behave, how you respond. If some of the regulators are voraciously questioning you without reacting, how you respond to them, uh, it may not fits in the professional standard, but it definitely fits in the ethical standard. And last but not the least, as it is applicable to all kinds of professional, I think the fifth point which I want to address is the commitment to excellence. So valuing assets is significant responsibility, and we need to ensure that we are performing our duties at highest level of diligence and care. We can't be careless that we missed looking into something, right? So I think all in all, I have given you the five frameworks. On the integrity side, I have, let's say, four things to communicate. One is the transparency in the effective communication with the client. If there is a pressure, you communicate. If something is not possible, you communicate. A conflict of interest must be avoided. Very recently, you have looked and seen in the economic times or even in the news that one of the foreign brand has the auditing firm in India, and they also have the advisory firm in India. What happens is when you are performing the audit, simultaneously when your advisory arm with the same brand is engaging with some other activities, in true sense, are you really objective in your assessment? That becomes a question. Rather, in business parlance, my business mindset says the cross selling is important. Let me get the audit work and let me penetrate with some advisory work. But real question is the certification work and the non-certification work cannot be done under the same brand. It must be done, separately. Uh, because somewhere, otherwise it results in the conflict of interest. So please avoid those conflicts of interest if you have in certain groups. Um, Next is obviously the confidentiality, and lastly, the ethical training. Uh, all of us undergo the technical training, but let me ask you this question: how many of us really go into uh, the technical training? That's challenge. Sorry, how many of us really go under the ethical training, and how many times? What is the frequency of undergoing the ethical training? This is something, the mistake which I did few years back. I used to do ethical training once in 3 years or once in 2 years. Now, thanks to ICI, they made it compulsory that you must attend ethical CP, etc. But ask ourselves, do we need a compulsive training program, or because it is so profound to our profession that we must proactively undergo the ethical training. I think it's important, to think around it. So in summary, I would say in my this particular knowledge dissemination of second section, I would say as a registered valuer, we are recognized for our responsibilities. We are recognized for our adherence to the regulatory frameworks. We are known and reputed with our commitment to highest standards of excellence, highest standards of ethics and integrity. And by doing so, I strongly believe that rather the combination of, whatever last 20 minutes I've been speaking, the combination of all this ultimately makes our value conclusions more reliable, more trustworthy, and definitely more valuable to the stakeholders. Now, finally, on to the topic. Though I have been speaking about do's and don'ts, I want to now very specifically delve into do's for registered values. And Madam was saying that I was trained by Mr. Swat Damodaran. He often emphasizes, the landscape of finance and valuation as a profession of continuously evolving profession. And when we say it's a continuously evolving profession, for obvious reasons, please understand new methodologies, new regulations, new market dynamics emerge on a very regular basis. Now, who anticipated few days back or a few months back, let's say a few years back, let me start from there, that the concept of blockchain would come? And you and I would definitely need to keep ourselves updated, not only by reading the conceptually what is the meaning of blockchain, but rather engaging with our engineer peers, engage with people from some of the top institutes, and go attend those certification courses, understand what is the meaning of blockchain and what kind of value it can really bring. Blockchain is just an example, by the way. And then, a few months back, we had OpenAI coming up saying that here is a large language model, Chat GPT, and through that, you can speak to non-human interface as if you are speaking to somebody who is human, who has empathetic response, who has a tonality to his response, and we never imagined that. But today it is happening. And how much of that facilitation brings value to my existing client, or how much of this facilitation devalues my existing client? Both things are very important. So we can't insulate ourselves by saying I will learn only how to calculate beta. I think those days are gone. You and I, we must learn the coding. You and I, we must learn how the sports works, how the technology works, how the event management works. We must learn businesses of our client. And because we have been rightly trained to, like a honeybee, to soak honey from the flower, we have been rightly trained to soak honey from our client, in a sense, the essence of that business, the dynamics of that business, which become ultimately critical in developing our business model. So regularly updating skills and knowledge, I think I should not tell you about it. I feel that there are vast resources of learning. Online courses and certifications are there. I must compliment all of you who are attending today's session. Likewise, ICI and ICI RVO, they conduct very regular sessions. Please actively participate with them. ICI also publishes professional journals. ICI RVO has rate books and many other professional literature. So, please read it. And if you don't want to read it, it's okay, but at least be curious. Go back and ask Gemini or ChatGPT those questions. At least they will respond to you. But remaining curious is important, right? And finally, there are lots of books and case studies which are available, and they are available on ICI website as well. So I think I'll not speak more on the fact that you and I must learn, which is a universal truth. We can't keep ourselves insulated from that level. Now, second, like I said, the thorough due diligence. In do's, the first was a learning, second was thorough due diligence. Now, thorough due diligence means what? Is it a case of deal making? Irrespective of the fact whether it's a case of deal making or not, you and I must research and collect data which is authenticate. You can't just go on Yahoo Finance and say, okay, I've collected data from Yahoo Finance which is freely available. Or maybe or Google, or maybe just go to some newspaper, or maybe go on Money Control. No, you and I know what kind of resources registered valuers are using, but how much they are real credible resources. And for a very fact, let me tell you, even they don't claim that these numbers are to be authenticated. So get a right data set, very, very important, very critical. Even when you have narrowed down your analysis to, let's say, 4 to 5 different comparable peers, please go back, download their quarterly financial statements of listed entities or annual financial statements and re-verify some of those data points. Look into commentary of the board, look into the commentary of management of those companies, and then formulate an opinion which is more comprehensive. Don't simply say that somebody does well in the revenue means that is doing good. Now that entity might have invested heavily on the marketing and not invested rightly in the research and development. So you can't be short-sighted by saying just because revenue of some company was good in this quarter, this company is doing great. Look at the example of Facebook. Few months back, okay, when they were heavily investing in Meta, the share price of Facebook went down. I mean, obviously during the COVID time it went up, right? But subsequently it went down. And I think the market was short-sighted at that point in time. You are obviously looking at uh, some another magic moment which could not happen, but Meta in that sense was one of the technological advancement, and it did not world did not embrace it the way it did embrace, let's say, the AI. But I believe that going forward, the existence of the digital or virtual world will have its own stake. And with the advent of Apple provision, I think the Meta and similar the virtual world uh, is there to boost, where we are looking at the augmented reality and we are looking at different kinds of virtual reality, augmented reality, and again the integration with AI and ML. So we are living in different world, and hence the data collection, and not only collecting the data but contextually analyzing it becomes important. So the context is institutional as well as the market driven, which is the overall macro level context, which means we can't just ask our juniors to say, okay, fine, fill in the data in Excel and just draw a trend. If the, let's say, average revenue growth is, let's say, 10%, you can assume, let's say, 10%. Average EBITDA margin, let's say 25%, you please assume it to be 25%. You may not really make these assumptions unless you sensitize them. So performing sensitivity is no more a factor of quantitative line item. It has also become a factor of qualitative line items, such as the technology disruption or the wars or likewise. So look at the competition, look at the demand supply, look at the macroeconomic conditions, look at the inflation, and then come back. Now my third point in the due diligence part is looking at the information and verifying it. So when your juniors perform a work, do you really cross check? Like, let me tell you the fact. A time in my practice few years back was such that I did not have time to cross check because I was engaged in something else, because I should do multiple activities. Like I'm also simple practitioner, as many of you are, and some of you must be a great practitioners. But let me tell you, common practitioners, because we are indulged into so many different activities, sometimes we have less time, and we believe that we have put in the standard processes and we want to rely on them. And it's good if somebody is doing work for you and you want to rely on that process. But I realized subsequently that sometimes processes may fail because of the human error, not because of the process failure, because of the human error. And such erred data went to the client, and client went back and said, Parag, you have not seen this. And I realized, I think it has direct the data conclusion is directly correlated to my reputation. So, please cross check the source. Please analyze the consistency of data. And if you believe you are not an expert, or your juniors or your seniors are not an expert, please consult with industry expert, auditors, and please, engage with those analysts to verify complex and ambiguous information. Don't assume on the management representation later. Okay, let's move ahead now. Now my next note point is about clear and comprehensive reporting. As a structure of valuation report, this is my recommendation. I mean, you can also create your version of valuation report, but I'll feel we should always have the executive summary at the beginning. This is do's, okay? This is a recommended do from my side. So we should have the executive summary, which includes an overview of the valuation, including the purpose, key findings, and conclusions. Then secondly, we should have the introduction, because that's where our report begins, where the background information is there, the asset being valued is there, the scope of the engagement is there, the methodologies that has been used, they have explained there. Then the third is the market analysis, because after introduction, you are trying to, perform a top-down approach, which means look at the market. first. So detailed analysis of the market, the outlook of the market, the trends affecting the asset, etc. And then you driggle down, narrow down your analysis onto the client, etc. Which means from global market to local market, from local market to local industry, from local market, local industry to the closed group industry, the closed group industry, peer group industry, from peer group industry to the client. And likewise, driggle down. Then comes the valuation methodology, because now you are saying this valuation is done in this context. This was the background, and this is overall the economic outlook that we have. And hence now the client related specific information and the global external factors, the combination of two results in this valuation. Okay. So which means explain the valuation methodology, then perform the financial analysis. Then please very clearly communicate the assumptions and limitations. I have seen so many people, not even giving right annexures. Like the value conclusion is there, but the DCF sheet is not attached as an annexure. And sometimes even the DCF is attached as an annexure, but the assumptions are not rightly explained. So let's not do that. Then many times you might be limited with something. So like limited with information, limited with particular scope. So also write down the limitations. And then maybe ultimately you can have conclusions and appendices. Okay. So having said that, there are again, according to me, four more things which are really, really important for you to explicitly mention. One is, if you have used the data source, please mention the data source. If there are assumptions, second, so one is data source, second is assumption. Explain all key assumptions. And don't only explain, like sometimes you say, I assumed growth rate 5%. Is it sufficient? No. In my opinion, you must explain the assumption and you must explain the impact of that assumption on valuation. It is not enough to mention the assumption, right? See, mentioning assumption is such a lame activity. I mean, why you need registered valuer to mention assumption? Mentioning assumption, you need somebody who can fill in the Excel file, who knows what assumption he has, right? What is the risk free rate? No problem. But mentioning that the risk free rate which I have used is a 10-year bond, because the road project which I am valuing has a maturity of 10 years. And the another road project, or let's say the construction project, where the revenue is, let's say, from the toll booth, I'm relying on, let's say, 20-year bond. Why? Because it's a more long-term project. So the risk-free rate in a single report for two arms of the valuation could be different. Now that explanation is necessary, and then how it impacts the valuation. Okay, so one is data source, second is the assumption, third is valuation rationale. Don't just say this is the value. I mean, mathematical conclusion obviously will give you some value, but you need to rationalize it. You need to logically articulate and well support why the chosen value or a combination of valuation methodologies gives you a value which is a fair value. It's not enough to say this is fair value. We need to extend and say why this value is a fair value. And finally, I strongly recommend everyone to use visual aids, which means wherever possible, please make use of charts, graphs, tables. Keep and present your report very clean. I mean, I agree, the true intelligence lies in the number calculation and articulation and building up the argument. But I equally believe that the more simplify you the complexity, the more you will be reputed in the society. And that simplification can definitely happen through such visualizations. Okay. Now, in terms of do's, let me once again come back on the direct examples of client communication. On the one hand side, I have already discussed about the clear and transparent communication, which basically means communicating, complex valuation concepts in a very clear and understandable manner in the report. Uh, Avoid using the jargon. It's okay to build jargons, but if you are using jargons or technical words, try to give the glossary as well. Those who are not adding glossary, please try adding glossary in your valuation reports, explaining those technical terms. But I have something more to tell you in terms of those. This is also something which I learned out of an experience. And this is something which I learned from my junior. I think we must be humble enough to appreciate those who are better than us. And I think this is something which I learned from my junior. I learned from my junior a concept of active learning and active listening. When I used to speak, he used to listen. When client used to speak, I never used to listen. I think I was arrogant at that time. Or maybe I lacked the feature of active listening. I think my junior has taught me a meaning of active listening. He taught me when client speaks, we must understand client's needs. We must understand client's concerns. And we must also understand client's objectives. And if client is hesitated to share or discuss, then we must also very artistically ask him questions, bring confidence onto him, and ensure that the communication is not disengaged. I think it's very, very important, to exercise the concept of active listening in client communication. Uh, Now, for some of you, those who are seniors, I think hopefully you will take it as a constructive feedback of this conversation. Okay. Now, the next point which I have is managing expectations. So, while in dues, we need to set very clear expectation when it comes to client meet. Like clients come with different thought process and different objectives, and not because they want to mislead you or you are gullible, but because they are very passionate about their business and their perceived value in one context, in one macroeconomic environment, could be fundamentally different than the reality check that you have. So there is a high possibility of expectation gap, and this expectation gap may in turn make him believe that you are a bad value. So how rightfully you communicate your and his expectation to each other is very, very important in building the initial trust. Provide a context. It helps clients accommodate your limitations. They would also appreciate, okay, fine, these are the limitations that you have. It's easy to communicate the same thing in a very arrogant manner, saying that this is how I'm going to do, that's it. But I believe that there are ways of communicating the same thing. So see if you could, work on it, work on that communication style. And one more thing which I feel is very important in this communication is addressing the concern. Be responsible and responsive to the client. If client is saying that, you have not responded to my email for last 5 days, be responsible. It's okay to say sorry. It's okay to communicate saying that I was genuinely busy without communicating arrogantly that, I am busy, I'll respond to you after 5 days. We are busy, please expect a response after 5 days. Instead of, communicating that, respecting client in a very responsive manner is important, that it is taking longer time than anticipated. And we believe that we should be able to give you, the right response by this particular date. The same communication, but in different language. I think, let's try to work on. Okay, now the next point which I have is induces maintaining the confidentiality. And I have a very serious question to all of you. How are you securing your storage? How many of you have independent servers? And a server could mean a cloud server, could mean a physical server. But I feel almost more than 90% of people I have met, they do not have a server-based mechanism. Anybody from their office, when they go on their desktop, can access to a particular file, looked into the previous client data, and the row level security is missing. This particular drawback is almost everywhere in the consultancy, which are SMEs. I think those who are large organizations, or those, let's say, who are considered to be top 10 uh, consulting organizations, I believe that they have realized the requirement of security. But in your case, I think it's important that you look at the better ways of storing. Obviously, I can't invest too much of time in explaining you this, but I think now the day has come where you and I have to invest very strategically, even on the security of the data points. Another point is data minimization. And when I say this, what does it mean? I have seen all of us collecting a lot of data from our clients through email. And then, copy one, copy two, copy three, version one, version two, version three. I don't want to go into a debate that why all these versions are important, but I feel that all of us definitely can work on data minimization, which means collect and retain only those data points which are truly necessary for valuation. And please avoid retaining any sensitive information longer than required. Don't do that. I have seen in certain cases, tax department, asking for your, hard drives, and then, some other information getting, you know, basically open of some other clients, and suo moto, they're taking action on them. So secure storage, data minimization, and doing regular audits of your data protection. I think these are three my recommendations. Then some other do's in terms of the legal implication, I feel, without anything else, I must say we must be compliant with the regulation. We must have the agreements in place where we have undersigned the confidentiality. And if there is a breach, I strongly recommend you must have a framework or a plan in place to report the incident. If any particular incident is happening, how will you respond to that? And that security breach not always mean a theft. It could also mean a fire in your office. Now, have you anticipated if this happens, what next? How many of you in your office have fire extinguishers? As a valuer, you would say, Parag, why are you asking these questions? But I'm very sure some of you are amused with my discussions, right? You must think like MNC. And why should we not have fire extinguishers in our office? And likewise, do we have, the card entry to enter in the office? Small security points, but do you belong to that category, or do you still belong to a conventional or traditional way of practice where you say, I'm happy the way I am because my clients are not expecting this advancement? And if that's the case, I think you have recruited the wrong clients, or rather you have not looked for better opportunities. I think you must recruit far better clients who say, I'll pay you more, but give me great service. Okay, anyway, I think I spoke more on this. Now let me, go into the don'ts, because how much time do we have? I think we still have some 30 minutes to spend, 30, 40 minutes. And hopefully, I'll try to cover some of the don'ts as well as the case studies. But I think all in all, we have some 40, 45 minutes. So I'll restrict my next dissemination for next 27 minutes. So let's say by around 3:30 or so, I conclude on my articulation, and then we open up the dialogue for Q&A. So I'm setting up your expectation that please bear with me for next 27 minutes if you are getting bored. Now, on the don't side, I think very first thing which comes to my mind is identify the potential conflict. My brother is independent from me. He takes his decisions independently. If he is investing in a stock market independently, how would I know that my independence is getting diluted? I cannot work for that listed company because of the definition of relative, right? So I think identifying the potential conflict is important. Uh, Behaving properly with your brother is also important so that you understand where is he investing, and both of you need to be, sharing and caring. I mean, this was on the lighter mode, but how can we avoid conflict and how can we remain objective is important. So first thing is personal relationship, which means valuing assets for friends or family. Like somebody came to me that, one of my friends said, my parents are shifting to Canada, they need certain valuations. Now, our team obviously had some other valuers who perform the property valuation, etc. So the real question is, can we do that valuation? And mostly, most of our clients come through the friend referrals, right? So then ensure that there is some objectivity around it, which means you don't understand because it is your friend, but other professional who may be, in your team, but who performs independent checks and then undersigns those valuations. Second is financial interest, which means, holding a financial stake in the company. Now, financial stake, I don't qualify share as a financial stake. I'm taking, this definition more broadly, which means, like I said, if one of the client in your other entity is giving particular business, let's say advisory business you are getting from that client through your other company. And then on the other hand side, you are undersigning this valuation where you look biased. Avoid that, don't do that. Maybe ask your partner to sign it who doesn't have interest in, the other entity, so that there is no direct conflict of interest. Then please also avoid, like I said, the dual role, which means I'm a statutory auditor and I'm doing the valuation. Now, is it regulatory allowed or not? That's sort of the different question. But I'm saying don'ts. We are discussing do's and don'ts. So don'ts are not only the legal prohibitions which I'm discussing. I'm saying avoid these practices. Don't do that. Okay. So then the next question is, how can you mitigate the risk, right? I think one is uh, disclosures, which means always disclose any potential conflict to all relevant parties. Now, my underlying assumption is that all of you are registered valuers, but I also feel, let me extend our sample, our population, by saying some of you might be working for some registered valuers as an employee or as a part of the team. In that case, also, for example, because now you are getting insider information of that client, don't go back and buy shares of that company in your wife's name or your father's name. I mean, that's not done, right? So these are don'ts. Whether they are okay or not okay in legal terms is altogether different thing. But if you found guilty of it, what kind of reputation you are bringing to this valuation profession? And forget about you getting caught for the insider trading, and there are altogether different rules for of the SEBI. But even apart from those rules, I believe these are don'ts. We must ensure in a practice which are considered to be high standard practice. Okay. I also strongly recommend that you should also perform the third party review, which means open up your uh, files and work to some third party like a peer review. Now you may not be legally required to perform peer review of your work, but how about inviting your professional peer and asking him to please help me, get my areas in the right places. If somebody looks from the third party view, I'm very sure that he will be able to identify some biases that you might have, or he'll be able to help you with lapses in the documentation and likewise. And lastly, I feel the ethical guidance. So we need to absolutely strictly adhere to those ethical guidelines. Okay. Now let's move ahead and let me discuss more on don'ts around the assumptions. I feel many of us over rely on the assumption. And ask yourself, at least in one of your engagements, like, let me confide. I remember I was limited with the data, which means I wasn't able to fetch the right data points. And then ultimately, I had no choice than to ask management that, okay, give me this data, which is your assumption. And because of the absence of any data point, whatever management has given, I had no choice than to rely on it. The real question is, okay, we can't over rely on the assumption, but have I test verified that particular assumption? And am I able to re-verify that assumption? So I understand assumptions are very much necessary part of the valuation, but over-reliance on them can obviously lead to inaccuracies. And those inaccuracies in hindsight will be identified as value which is different than fair value. And then you will be caught by some other regulator saying that, how can you assume this? And lot of such over assumptions are happening in insolvency cases. Like a case of uh, intercompany deposits which are not recoverable. Now you can't trace a company, and then you have to rely on certain assumption. So what will you assume? Either you will assume that none of the money will be recovered, or you will say some money will be recovered. But that some money means what? And that's where the assumption comes. So I feel all in all, my personal recommendation is, in terms of don'ts, don't over rely on the assumption. In terms of do's, I would say fact-based analysis obviously is going to enhance the reliability and accuracy of your valuation. So please, drive your valuations through facts. it provides a very concrete foundation. And ultimately, stakeholders can trust, reducing the risk of errors and those pitfalls or misjudgments. One more thing I want to address before I go into the case study is I have seen people doing speculative valuations, and I have seen it happening in the early organizational stage, like startup stage. With the passion of founder, he says, we will achieve revenue of so much. And when you mathematically try to prove him that in order to achieve revenue of so much, you need to reach so many people. And in order to reach so many people, where you have the customer conversion ratio, you must spend so much as a marketing budget or a sales budget. And in order to spend so much, you must first raise so much, right? But with the limited money, you can't spend so much. And with this money, because you can't spend so much, you can't earn so much, which means revenue is linked to the cost. And because you can't earn more, your valuations will also reflect that role valuation, right? So there are pitfalls of speculative valuations. Often we have seen people quoting high revenues, thereby high profitability, and those high profits drive high valuations, when in the reality, profits don't come first, cost come first. Only when you have money, then you can incur the cost. Only when you incur the cost, then comes the revenue. And once the revenue comes, then the money goes into the working capital of the second revenue, and then there is a free cash. So the speculative valuations must be avoided. And I hope all of you are able to understand what I'm trying to say. So in speculative valuation, first thing is inaccurate estimate. Second is market misinformation, which means the industry is growing at a particular rate. And when I ask that professional, uh, from where you got the industry growth rate, and he said, I googled it. One of the research reports said this is the industry growth rate, and you don't know. Can you really rely on that information? It may be published by, let's say, a renowned publisher. Still, I feel until and unless you have bought out that information, you can't rely on it, because you never know, these publications could be sponsored publications. And it could tend to be as great estimates as exit polls of the elections, which almost all were wrong, right? They were all great estimates and they're good to utilize for the debate. But when the reality comes, they are finally different. And hence, what I say is market misinformation. And finally, obviously, it translates into the reputational damage. So please avoid that. I would strongly recommend, keeping abreast with the legal update is important. If there's a new reporting standard which is coming, for example, now the lead standard is done, the old Ind AS 17 and Ind AS 116 came, or IFRS 16 came. Now, few more new standards coming on the reporting side. So keep yourself abreast. Ensure about the tax regulations, which scheme the companies are undergoing. I have seen people not adjusting their profitability for CSR activities, which is one of the mandatory provisions of the Companies Act. So in your valuation, it could be as low as 1% or 2% or 3%, doesn't matter. But have you performed that adjustment which is in line with the Companies Act? It's important. I have seen people carrying depreciation calculation as a simple calculation without differently calculating it for the tax purpose. But your tax outflow is dependent on the tax profitability, and your tax profitability is dependent on your tax rated depreciation. And hence, in your valuation model, you must calculate depreciation both Companies Act wise in order to calculate your normal profitability, which in turn will be utilized in EPS and then your PE multiple and likewise. But in order to reach your tax amount, you must calculate depreciation for taxation purpose separately. So I think, I tried my level best to give you a lot of different areas. Now, I think if time permits for next 10-15 minutes, I'll try to, discuss some of the case studies. Let me first explain you some of the case studies of good valuations or successful valuations. So there was a technology startup, and it sought valuation for Series B funding. Series A, I mean the seed capital, angel fund, Series A, Series B funding, right? And Valuer employed a meticulous approach, combining the discounted cash flow method and market comparables. And the key steps included thorough due diligence, where it looked into startups' financials, market conditions, like I said, the competitive landscape, which is very important to look at the margins, and it verified the financial statements and revenue projections as well. But it did so through revenue analysis and third-party validation. No, not always as a startup valuer you may get a third-party validation, but in a given case, he got the validation. So it was one of the case of successful validation. While we verified his report, it was very clear in terms of communication. So final report was quite comprehensive, well structured. The assumptions were detailed. They were explained. They were not only mentioned, but they were explained why and what is its impact on the valuation. He has rightly explained the methodologies, rightly given the data sources. The glossary was rightly done. And more importantly, his report also included sensitivity analysis on the data which was truly sensitive. The data is sensitive to certain points, and if you perform sensitivity analysis to out of the different points, does it really make sense? It doesn't, right? And overall language was also good English. So as a valuer, I expect you to be good in communication, which also means good in English, because English is the communicative language that we are utilizing. You must know the difference between comma and semicolon. You must know the difference between dash and hash, right? Dash and hyphen. When should we use the backslash and when should you use the front slash? When should you use that and when should you use which? So this is English, and English must be good. You can't say my English is bad or I'm doing grammatical mistakes. So all in all, the English was good, the language was good, the explanations were great, the content was great. And the key learnings from this particular analysis was there was integration of multiple methods. So it was not heavily reliant on only single method. Secondly, the reports were detailed and transparent, very clear and comprehensive. And thirdly, the report, when I started reading and ended on, let's say, 40th page, I must appreciate it was a continuous engagement between me and those pages, which means it was very effective communication that ensured, the alignment and trust between maybe me as a stakeholder and a valuer who performed the valuation. So all in all, these three learnings. Maybe, let me give you lessons learned from some of the failures, I think. And it was a valuation of e-commerce company, which was overvalued during, its IPO, obviously leading to significant financial losses to investors. Now you can imagine such companies, right? E-commerce company, which was overvalued at the IPO, and after the IPO value went down, obviously that resulted in losses. And may not be always e-commerce, but you can look at some other comparable IPOs that have happened in very recent times. If you go back and look at why valuation went wrong, why price in the market is significantly lower than the IPO valuation, I think there are three major aspects according to me. One is over reliance on assumptions, which means management believes something without you validating, you are relying on it. So over reliance on assumptions. Second is, I think, inadequate due diligence, which means either you have not rightly utilized the data sets are not proper, they are not reliable, you have not performed primary research and secondary research, you have not done right sets of interviews of right people, you have not discussed many aspects with those charged with governance, you have not hired expert. So inadequate due diligence. And I think third could be one of the possibilities of poor communication, which means the company going to IPO communicated something to the valuer. Valuer had his limitations, but he could not very effectively communicate the risks and uncertainties associated with those that particular exercise initial to the client. And secondly, because the in prospectus in IPO you have to give the valuation and explain. I think valuer or company both they must have also failed to explain to their investors potential risk involved in this valuation. That price at which IPO is getting listed, it's a value that needs to be communicated effectively with relative risks. So I think there possibly a gap between the way communication was written in prospectus or communicated on different news channels vis-a-vis the reality of the number that was calculated. So what was the lesson learned here? So I think I'll communicate this lesson learned, and then maybe I'll take one more case study of manufacturing company learnings. But in this e-commerce case study, there were three lessons learned. One is that we must always ensure a fact-based communication, because if tomorrow when you receive a notice from the regulator, you can't say I relied on uh, the assumptions of the management. Today, if you go back and look at the IBBI website, they have given orders suspending licenses of so many valuers just because they say that we have relied on the submission of the management without test verifying it. So please, be a little more responsible than simply over relying on those assumptions. Secondly, perform the diligence. I mean, the due diligence is necessary, which means going little extra than just fact-based data points. So data is important, but you must go little beyond data, where you look at the qualitative aspects and likewise. So consider thorough research, consider all relevant factors, context, macroeconomics, outlook, relevant risks and uncertainties. The third point was the communication, which means you have there is a risk of communication. If as a valuer, if you have not rightly communicated it, then regulators are going to haunt you. So please communicate wisely, communicate clearly, and communicate thoroughly. So that was second case study. I can give you, maybe for last 5 minutes we have. So I can share one more case of manufacturing case study where we undervalued the manufacturing company. So it was a merger case, and um, we did the valuation, but in hindsight we realized that we undervalued the company, obviously resulting in loss of value for company shareholders. And obviously we realized it subsequently. Now, one of the argument could be, in that context, the value looked great and hence deal happened. But we believed that there was also scope for further negotiation. Obviously, when the deal happens, if it cannot happen at fair value. Let me tell you why. If somebody is acquiring you at fair value, it means he's simply buying the present value of future profits. So he doesn't gain anything. So usually when deal happens, winner wants to buy a value which is little lower than fair value, which means he's gaining something. And seller, because he's on the selling point, must agree to such value. So we were on the selling side. We believe that obviously there was a value concluded which was lower than the fair value, but we believe subsequently that it was significantly lower than fair value. And I'll tell you what were what were the pitfalls. I think we failed to appreciate the positive market trend and technology advancement, mostly technology advancement that significantly enhanced, companies' future prospects. Now, ultimately, you and I can sit here and theoretically understand or analyze why some value was accepted, why some value was not accepted. But this is our pursued analysis. We feel that we might have more positively looked at the market trends and technology advancements. Second, we believe that we might have somewhere ignored some of the regulatory changes, which ultimately favored manufacturing sector, like Make in India, where and then some tax benefits and likewise. So we did not anticipate, or we believe that the company may not achieve those particular company could not achieve those licenses. But I think we ignored that. We should have considered it in identifying the synergetic value. And last but not the least, the lack of verification. I think we did not adequately verify the data, which led to the errors. So when the deal happened, it so happened that we did something, but our team and entrepreneurs deal, the selling company's team, we did not was very rightly aligned to each other. And when we concluded, in due diligence of the acquirer, they identified certain errors which were not attributable to the valuation, but they are attributable to the accounting or their existing numbers. But because of that, the value got adjusted. So what were the lessons learned? Finally, for me, the lessons learned were, we need to definitely stay informed with the market trends. We must look at the market. We must go into the market, speak to people. Ground realities are important. Secondly, looking at the regulatory update or its impact is important, including the tax benefits. And last but not the least, when management gives the data, Also look at the audit report and check whether it has a disclaimer of opinion, it has a qualified opinion, and whether to that extent adjustment is necessary. So ensure the data accuracy. Very, very important. I know for a fact they create accurate data as of 31st of March, but data as of 30th June is not really accurate. And you create it just because you are doing the quarterly conclusion in case of private companies. But how can go closer to the accuracy becomes important. So finally, I think in conclusion, I would say analyzing both successful and unsuccessful case studies of your own clients will definitely provide you with valuable insights into practices that lead to ultimately accurate and reliable valuation. And obviously, there are certain pitfalls that we must avoid. The overall takeaway for this discussion, which I want to give you in do's and don'ts, is comprehensive reporting, clear communication, effective communication, adherence to ethical standards are foundation. And I must congratulate ICI, RVO and ICI. They come out with a wonderful book about do's and don'ts. So maybe after my discussion and Q&A, Sarika madam can navigate you from where can you get that book. And if you want to learn more about do's and don'ts, I'm very sure that that book could be more helpful. So with this, I think on time, I would love to take a pause here and maybe wait for any Q&A if we have.
Yeah, sure, sir. My team, I have Dimple here. He will put in chat box whatever the questions are there.
Sure.
Hello, sir.
I am
Okay.
putting Manoj.
So let me read out the question that I have. A listed company wants to get done valuation of corporate guarantee for accounting under Ind AS for internal purpose of management. They are ready to give appointment letter signed by group financial controller and not by audit committee. They are okay if the valuation report is addressed to the group financial controller. Can we accept this assignment and address the report to the group financial controller, or should the valuer deny this assignment? You please mention that you're performing this engagement not under particular rule. So I have two suggestions here. First is, can you accept the engagement? Answer is yes. Can you address this engagement was done for the limited purpose of financial control? Answer is yes. But the third relevant question is this, that under Ind AS financial guarantees must be valued and must be recorded. So if they want to call as if they are doing it for their internal purpose, but ultimately going to capture that value in financial statements, then I think they are breaching their commitment, which means you need to limit the purpose of utilizing this report. If they agree that this report will be utilized for the number will be utilized for financial reporting purpose, then accordingly you must be appointed by either audit committee or even the financial controller, but in which case the audit committee must designate financial controller as a person with all authority to appoint you. And where controller is an agent and acting on behalf of the group of people like board or the audit committee. And I think in that case, it should be okay. So, okay. Second question that we have is, quality factors are critical. Appreciate they are. How do you validate factors like war, obsolescence, and future technical advancement in valuation? I'll quickly explain that. While anecdotally we have heard and read that these can be factored as discounts or cash flows or both, and I practice this as an art and creativity of the valuer, how apt are these whimsical discounts or cash flow adjustments are? Is it not apt to work on advanced mathematical models, regression analysis, etc.? If so, what are the best practices on this and make it weird to science than conjectural art? So I completely agree. I mean, obviously the question goes on, but I have understood the soul of the question. Often we call valuation as art and science. Please understand that. Please don't call valuation as art in passing whimsical judgments, as you have mentioned in your question. The qualitative aspects can definitely be quantified. If you look at the intangible asset valuation standard, which goes into 300 series of ICI valuation standard, specifically, we have given the technology obsolescence and other obsolescence must be factored in order to capture the technology advancements. So imagine a software getting valued. As of today, we are valuing the software which was created since last 3 years. So even if we deploy the replacement cost method or reproduction cost method, the additional mechanism or framework is necessary to capture the obsolescence. And that obsolescence needs to be then rightly computed. Obsolescence may come out of the qualitative factors. And sometimes it may not be always technological obsolescence, but it could be non-technological obsolescence as well. For example, though you have prepared a software which is technically feasible, it is not commercially viable, which means it is getting reflected with low revenue or no revenue. So it becomes one of the qualitative factor. Though it's a quantitative in nature, no revenue factor, low revenue is a qualitative factor. And then the synthetic credit rating or synthetic rating will help you to kind of build a framework and then quantify the obsolescence. I think, okay, the next question which I have is about the AI. That while doing a AI project valuations, we found that was sounding a brilliant idea. The new advancement in other geographies were virtually making this concept redundant. Valuation being at point in time, how does one on that date cull info of what is in the womb of competition to make valuation contemporaneous? A very valid question. Obviously, we work with the limited data points. We can't expect to know exactly as of that date what is happening with the competition. But we know generically what is a trend. And you can observe the trend by looking at the quarterly financial statements of the listed entities who are the leaders in that market. So for obvious reasons, we may not have the exact information as of that date of the competitive landscape, but having the information and looking at the transcripts of analysts of the listed entities will help you understand where the industry is growing. Whether, like, because you have used the word AI, uh, your and my job will not be eliminated by the AI. I think it will be eliminated by a person who uses the AI. So tomorrow's unemployment is a combination of removing certain people, but more importantly, by not recruiting additional people. So people are getting graduated, but they're not getting recruited. And there are certain works at the top which now can be done by, let's say, 2 people than previously, which used to be done by 10 people. So having said that, these numbers ultimately get reflected in the finance by way of employee cost or by way of the profitability. Now, how you interpret financial numbers along with the analyst transcripts will ultimately set the tone while you analyze the competitive landscape. Okay. Now, the next question that we have is, what is your view on getting your valuation report peer reviewed and getting peer review certificate? A glance peer review without accountability is more dangerous than non-peer review. Will you advise the authorities to make it mandatory, more particularly in big valuations? Uh, I think certainly peer review is a great concept. Like originally, peer reviews were not mandatory on the auditing side, but as debacles happened for the larger organizations such as listed entities, ultimately we mandated the peer review for auditors of the listed entities, which means you can become the auditor of the listed entity only if you are peer reviewed, which means, peer review means the set practices are there. So having said that, I think a peer review can be a great thing, but I, on the other hand side, I also appreciate that each valuer may have, very confidential way of performing a work or data sets. I strongly believe that peer review is a great advancement for a profession. If it happens and becomes mandated, I think it should be a welcome. It should not be used as a tool to pull somebody down, but rather it should be used and looked as more of a empowering tool for all of us. I think these are some of the questions that I had. Any more questions if you have, madam?
No, sir. These are the only questions that have come up
So I think
as
I'm
of now.
glad that we could, conclude in time because I believe that you have a great surprise for all of them. You have to offer them the insights into the great event happening in the month of July at Bharat Mandapam. And there is a small presentation I understand which you want to do. So if there are no more questions, then I would love to give back this talk on to you, and you can take ahead the conversation with our audiences.
Yeah, sure, sir. There are no more questions as of now. And basically, I will take them through the brochure, what we have for our convention, as well as the website. Yeah. So, as already informed, this is second edition of this International Convention on Insolvency Resolution and Valuation. The first convention was held in Singapore last year in August. Theme of the convention is enabling resolution, maximizing value. Again, it is organized by Insolvency and Valuation Standards Board. It is in Bharat Mandapam, which is in itself a brand. Not anyone and everyone can enter without having a valid pass to this venue. This is under the leadership of CA Ranjit Kumar Agarwal sir, who is the president. CA Charanjit Singh Nanda sir, who is the vice president. CA Gyanchand Mishra sir, who is the chairman of IVSB. Then we have CA Durgesh Kumar Kabra sir, who is the vice chairman of IVSB. And it is jointly with the NIRC, where the chairman is CA Abhinav Agarwal sir. So, who should attend? I've already briefed, but still, insolvency professionals, registered valuers, professionals involved in valuation process, professionals involved in the process and its multidisciplinary issues in insolvency and bankruptcy, regulators, industry or domain experts, judicial members, accounting or finance professionals, financial consultants, bankers or investors, policy makers, research scholars, registered valuers entities. Then again, why to attend? Firstly, we'll have this basically all everyone who's gathering here has something or the other on insolvency and valuation, which is a big opportunity nowadays. So a unique opportunity to learn, share, and upgrade. Insights on important insolvency frameworks and valuation process and methods across different jurisdictions. Knowledge about emerging global trends, avenues for the profession. Technical sessions by eminent speakers, experts. Learn to face the challenges based on experiences shared by trendsetters. Networking opportunities with industry experts and peers across the globe. The thematic issues which will be there are debt restructuring and insolvency regimes global trends, time constraints in conducting through valuation, effective IBC and valuation framework, the role of regulators and policy makers, balancing stakeholder interest in the process of insolvency through valuation, insolvency process perspective of creditors, integration of technology for value maximization, judicial decisions taken by the judiciary vis-a-vis objective of IBC, ADR, alternative dispute resolution in insolvency vis-a-vis IBBI, report on mediation as a tool, digital assets and insolvency challenges, then group insolvency as an emerging resolution tool. So we will start on 12 July around 3 o'clock, which will be, then we'll have dinner, which will be up to 9 p.m. Then on 13 July, we will start sharp at 9 o'clock with the breakfast, and then it will end up to 6 o'clock. So this is about resolve. We have also sponsorship opportunities here, where we have different slabs. Anyone can connect to us at ivsb@icai.in. Whosoever have any question, we'll personally attend to all of them. The fees is 7,500, which can be claimed till 15th of June. 15 June onwards, we have this 10,000 plus GST for chartered accountants. For non-chartered accountants, it is 10,000 plus GST. 15 June onwards, it is 12,500 plus GST. And for foreign delegates, it is 250 USD. And after 15th, it is 350 USD. So, also our website address is resolve.icai.org. You can connect to us. These are the numbers which have been flashed on the screen now. You can connect to us and we will guide you through. Kindly mark your calendar and join us for this resolve. This is all for today. Yeah. Parag sir, I have completed my presentation on resolve. Do you have any concluding remarks?
No, I mean, my concluding remark would be see how can we have more valuers, coming for this particular event. And um, I think as a community, we must rise up, we must support each other. There were some few good suggestions given by valuer, we must consider it. And I think democratically, I think, we should go ahead and see how registered valuer becomes the sole agency to perform valuation across various rules and regulation. So with this, the change in government, my urge to uh, professional body is that if not happened in last 5 years, 10 years, at least in this segment, we will see how can we see through that registered valuer body becomes the sole valuation providing agency, maybe under income tax, maybe under FEMA, and likewise. We are hoping for it. I know these are typical questions that are come, and trust me, the lady who's given you this information, she has been really fighting for it on behalf of us. So, madam and the entire board, all the best to you as well. A lot of compliments from our side, and we hope that ultimately you get us what is rightfully due to this profession. Thank you so much.
Thank you, Parag sir, for elaboratively, along with the case studies, discuss about the do's and don'ts. Best practices are always the best practices. They cannot be rules or the law. But one should always see that law should be followed in letter and spirit. In the true spirit of it, we should follow all the guidelines that have been given by the regulator. They may be correct from one's perspective, they may not be correct from the other's perspective. We may give representation where we are finding it difficult to apply. However, it is very important that whatever has been prescribed by the regulator, it is our duty to abide by it. If we would not abide by this, today we can feel it is very narrow, it is not good, it should not have been done like this. But still there is some thought process, a detailed discussion on it, some objective to any amendment which comes there. And there are lots of judgments which have been given by IBBI, only a few on the registered valuers. Please go through them so that you understand the perspective and you may also correct yourself. From ICI RVO, we have recently conducted a webinar on do's and don'ts, findings of inspection report. So we also undertake this process of peer review as well as inspection. In the peer review, you have actually multiple roles. As a chartered accountant, if you are a registered valuer, if you are an insolvency professional, you are a registered valuer because you are a chartered accountant. You are an insolvency professional because you are a chartered accountant. So these cannot be treated differently. However, regulator for both these professions are different. There are certain things which have been prescribed in companies' registered valuers and valuation rules that you must read carefully and thoroughly and apply. Like I'll give a few suggestions, like examples on it. Once we issue a valuation report under the Companies Act provisions as well as under the IBC provisions, what we mention is we do not even mention our IBBI number, our RVO enrollment number. We write our membership number as a chartered accountant. Many of us, we issue it on a letterhead of chartered accountant. Mind it, these are both different professions. Even a firm, which a CA firm is not allowed to undertake valuation assignments under the Companies Act as well as under IBC, because these can be undertaken only by a registered valuer enrolled with a registered valuers organization and registered with IBBI. These are only few small things which you need to take care. Please mention your, again, this is a best practice. Please mention your IBBI number, RVO number on every report you issue. Please do not issue it on your letterhead of a chartered accountant. These are few basic things. Please mention clearly what are the valuation standards you have followed, which of the methods you have adopted. Go through the guidelines on caveats, limitations, what is being allowed, what is not being allowed. So best practices will itself emerge. If we will have a habit of reading carefully and thoroughly anything which is coming up. In valuation, we do not have many amendments that are coming. 100 साल पहले या 50 साल पहले, what was the law is the law today. There are three approaches. Earlier also there were three approaches. Now also we have three approaches. There are same methods which we had 50 years before and today also. So my humble request is kindly go through the law, read the publications that have been brought out. Specifically, we have brought out a publication which sir has also spoken about, Handbook on Best Practices for Registered Valuers. A code of conduct is also prescribed for the registered valuers to follow, which is updated on ICAI RVO website and is also part of company's registered valuer and valuation rules. We have bylaws governed by the bylaws. We have to follow those bylaws. So with this, I would again request each one of you to go through the rules, regulations, sections, and also the best practices which are prevalent. The guidelines which have been brought by IBBI or the advisories which have been issued by RVOs, so that there is no chance of missing anything. With this, I would thank each one of you. Parag sir, do you want to say anything?
No, I think you have wonderfully concluded. So let's go with the same test. Thank you so much.
So on behalf of Insolvency and Valuation Standards Board of the Institute of Chartered Accountants of India, I would again like to thank Parag Kulkarni sir for this wonderful session. Kindly join us at 2 p.m. on 13th of June. We have our next session on valuation itself. Information will reach to you. 20th June, we have with us CA Sujal Shah sir, who is also talking about valuation report and documentation. So kindly be with us. 13th June, we have CA Sujal Shah sir. 20th June, we have CA Deenal Shah sir, who will be taking intricacies of valuation along with taxation and other IBC and other taxation aspects. So thank you each one of you for joining. In absentia, I would like to thank CA Gyanchand Mishra sir, who is the chairman of IVSB. CA Durgesh Kumar Kabra sir, who is the vice chairman of IVSB. And thank you IVSB team for supporting in this initiative. Thank you one and all. Thank you so much. Thank you, sir. Yes, please.